Hey guys, Robert Roy, founder of WealthBuildersHQ.com here. As a trader or an investor, our ultimate goal is to make money using the financial markets. But we understand that carefully managing your trades isn't for everyone. That's where things like ETFs, mutual funds, index funds, and so much more come in. In this video, I'm going to go over what they are, how they work, their differences, what to consider before investing in any of them. So let's start off with what most people know is mutual funds. Well, where do you see them? In your 401ks at work, your financial advisors suggest that you put money into them. You get handed a list of these are the ones we have available. Just pick a couple out and throw some percentages up there and we'll see how you do in 40 or 50 years from now. When you look at the definition of a mutual fund, it's a basket of something. It can be stocks, it can be REITs, it can be financial markets, it could be precious stones, gold, silver, things like that, metals. There are a variation of things that you can have inside of a mutual fund. Ones that are located in the US, that are located international, that are aggressive, low risk, things like that. When you look at mutual funds, how do they perform? On average, you're gonna get about 8% a year, right? And that's pretty much what it is. What you don't know or might not be familiar with is how high some of the fees are that are inside of them. Right, when you look at things such as, let's call it the B12 fee, which is the firm advertising that mutual fund, trying to get new customers so they can make more money and you get nothing from it, but hey, you paid for it, right? Or your A shares versus your B shares, where you get a higher or a lower interest rate, how long you have to hold them, if there are loads on them, front load or an end load. When you buy it, you pay a percentage, or when you sell them, you pay a percentage. So if they did a really good job for you, they take more money at the end, right? But they paid you a lower percentage in there because you took B shares and so forth. I'm not a fan of mutual funds. Who are they right for? They're right for someone that doesn't have the time to do any of the work themselves. If you just say, I'm gonna throw my hands up and whatever happens when I'm 65 or 70 years old and I'm ready to retire, I will just close my eyes and accept the results. I think there's a little bit more that we could do outside of that. So as an example, you could go and look for things such as index funds. When you look at an index fund, it could be a fund of the S&P 500, or it could be an index fund on the Dow, the NASDAQ, the Russell 2000, right? There are many different index funds. When you look at the benefits, the costs are so much less than a mutual fund. So if you have a blue chip mutual fund, basically they're tracking IBM, Microsoft, things like that. Well, why not just go ahead and get an index fund in the Dow instead? Well, I'll tell you why they may not be right for you is the cost. The index fund can be a little bit more expensive, right? There are some index funds out there that are built in where you've got to hold them for a certain amount of time. So there's some caution in them, and they really wrap more around some of the annuities. You'll see more of the indexing type funds in there. I am not a fan of index funds, but I like them better than I like mutual funds. Instead, what I'm a huge advocate of is trading ETFs. ETFs are what are known as exchange traded funds. So as an example, you have things like the SPY, which is the S&P 500. Its nickname is the spiders. Or you have the diamonds, which represent the Dow, or the Qs, which represent the NASDAQ 100. Right? IWM, IWN are both the Russell 2000. Right? You can now go ahead and trade an entire basket of stocks. And if the Dow is trading at $26,000, you can trade the diamonds at a very low percentage, just a few $100s. The same thing with the spiders and the Qs. And there are percentages of how they trade. So a $2,000 index on the S&P 500 would be a $200 SPY. A $3,000 index on the S&P 500 would be $300. So you're not buying $3,000 a share, which you might need a little bit of money if you wanted to buy a bunch of shares. You're buying a $300 share instead. To me, by utilizing the ETFs, some of the biggest advantages you have is you can buy and sell them intraday, which by the way, you cannot do on mutual funds. If you call the fund broker, when I'm doing this recording in the last couple of days, we've seen the Dow drop almost 1,000 points. It's recovered a little bit on the third day, which is today. But if you called and said in the middle of the day, hey, sell my mutual fund yesterday when the Dow was down almost 500 points, the broker's gonna say, absolutely, we'll sell it. What they're not telling you is they're selling it at the 4 o'clock price. If you wanna buy it, you buy it at the 4 o'clock price. You can take no benefit or no gain and additional risk by trading these at the end of the day. You cannot get in and out. You cannot weave in and out. You can do that with ETFs. You also have very low expense ratios. Closer to 0.5% is the expense ratio on an ETF versus 4, 5, 6+% on some of the mutual funds out there. I helped a client one time. They had some mutual funds and they could not understand why they were getting crushed with bonds, and the bonds were doing great that year. Well, they found out that we had a junk bond fund and the fund manager was churning the account. So every time they buy and sell stocks. So as an example, if the entire mutual fund was 100 shares of Microsoft, if they sold that 100 shares and bought another 100 shares of something else, that's a 100% turnover. In a mutual fund, that equates to about 1% that you will pay that year for that turnover. Well, they had the bond funds they were in were 7, 8, 9% turnover. So 7, 8, 900% is what they were turning over the entire fund 7, 8, 9 times in a year, and the customer pays the price for that. You don't have any of that with ETFs. They're optionable. What does that mean? You can buy calls, buy puts. You can do credit spreads. You can do covered calls. You can do the upside down Flint rubble bubble trade if you can come up with one. All right, whatever trade there is on an option can be done with an ETF. You could sell naked puts, naked calls. The opportunities, the ability is endless of what you can do with the ETFs. I am a tremendous fan of them. I like the SPY. If we look at an option chain on SPY, so let's go ahead and take a look at the computer and take a look at the SPY chart. So as we look at an SPY chart, right now, the S&P 500 is trading at 2,900. The S&P ETF, which is SPY, is trading at 289.29, right? So we're right there. You might see it, it's faint in the background. It says SPDR, Spiders, S&P 500 ETF. It's a 5-minute chart. So each candle represents 5 minutes. You can see the drop I talked about in yesterday, as well as the previous day. We got crushed. They're talking about one of the worst drops in years. Well, we can also bring in an option chain on the SPY. And this is TradeStation. You'll find option chains on every single platform you use. Right now, the nice thing on SPY options, you'll notice it is a Thursday. So we have an option that expires in 1 day, an option that expires in 4 days, an option that expires in 6 days, 8 days, 11 days. See what I'm doing here? Every other day, there's basically an options expiration. 4 days, 6 days, 8 days. That's Monday, Wednesday, Friday of next week. You have options expiring. So as we look at the SPY option chain, we're going to come down and we're going to find a delta range that we're comfortable with. And let's say we're looking for a delta 65, 70, whatever it is. I've got a 68 delta. I've got tons of open interest on this option right here. And I'm looking at a price of about $2.59. That's an option that expires in 1 day from now. So we're sitting at 1 o'clock in the afternoon. We've got a day and 3 hours until this option expires. But I can get in this trade with a 69 delta, call it a 70 delta, and every dollar that the SPY moves in a day, right, today, we're looking at about a 70-cent move on my options price. So there's tremendous value here. We could look at other options such as the QQQ. It's a great option. It's a great vehicle, great trading vehicle. They have options that expire in a day, in 4 days, in 6 days, in 8 days, right? No, that's the SPY. They have options that expire in 1 day, in 8 days, in 15 days. I like the SPY one so much better because not only does it have more choices on the option chain, but there's more open interest on it as well, which means there's more people at the party. I love going to parties. I just hate being the only one there. I like when there's a lot of people at a party. Right? That's the difference between the Qs and the Spiders. Still really good volume on the Qs, but I like the Spiders so much better because of that. So whether you are a trader or an investor, I hope you found this insightful. I hope you were able to take a couple of nuggets of gold out of there to help you understand exactly what can help you in the future as that trader or investor. So here's the question of the day. Are any of these in your portfolio? And if they are, have they performed to your expectations? Let us know down in the comments below. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and we'll see you in the next video. Folks, thanks for watching the video. I hope you enjoyed it. If you did, please make sure to give it a thumbs up. Go ahead and click the subscribe button so you can follow along with all of our great content, and ring the bell so you never miss anything new that comes out. And folks, with that down below, we've got a couple of other videos for you to choose from that you can watch from our materials.